Hopefully we can get these field queues behind us permanently this year. But now let's move on to our first conversation. Now we see the Central Bank of Nigeria announce an important change in the tenure limits of banking executives and non-executive directors. The most significant shift by the CBN is that bankers will now serve a maximum total of 20 years as executive or non-executive board members. For analysis now, let's talk to Kelvin Emmanuel, economic expert, joining us from Abuja studio. Good morning, Kelvin, and it's nice. I believe you could get fuel to come to Abuja studio today.
Good morning, Ladi.
Good morning, Kelvin. Yes, yeah, so I guess the issues still remain with us. But let's look at this 20-year limit now for bank executives. Break it down for us. What does this limit really mean for these bank chiefs?
Well, so the central bank basically release a circular that says that group managing directors that have left the banks and, for example, are going to go into the holdco structure of the same banks, because if you check most of the banks from 2012, when First Bank and Stanbic IBTC set up holding company structures, most of the banks have now reverted to holding company structures. GT Bank, Access Bank. I think Zenith Bank is the latest that has its holdco structure approved. Quite a number of them, following the fact that in 2009, 2010, the past governor of the central bank, Sanusi Lamido Sanusi, had stopped the universal banking model and required that the banks focus on their core banking business. So basically, he says that if you've been a group managing director for 10 years, which is the limit until this circular was announced, you're not allowed to do more than 12 years cumulatively, even if you become the MD of the holdco company, And by this, I'm sure Mr. Segun Agbaje that is gone to the holdco is going to be targeted, and quite a number of them. He also says that for executive directors and deputy managing directors that have done a cumulative term of 10 years are not allowed to, in case they are promoted up the ladder, they're not allowed to do more than that 10-year limit. And he also says that if you've been in executive management, you're not allowed to do more than 20 years cumulatively. Now, the reason that they're giving is that, they want to create an opportunity for the younger bankers who are immigrating from the country to have a career path through the system. But then you need to ask yourself that, considering the fact that in the holding company structure, which in my opinion is a backdoor for universal banking that Sanusi Lamido Sanusi had banned about 13 years ago, they have other regulators that they answer to. They have the likes of NICOM, they have the likes of the PENCOM, they have the likes of NCC, Securities and Exchange Commission. So the question you have to ask is, did the central bank actually check with those regulators before it passed the circular to say that these executives are not allowed to serve in the holding company structure? Because you cannot discount the fact that the banking industry is a very delicate industry, requires a lot of skill and a lot of experience. And having EDs and DMDs under the tutelage of the group managing director is absolutely critical for that passage of baton and that change of guard. It's not an industry where you can just bring anyone. You need cumulatively somewhere around maybe 15 or 18 years of experience to have the wherewithal to rise up to the position of either a deputy managing director or a group managing director of a tier 1 bank in Nigeria. So for me, the question I have is, was this like a target for executive who protested against the governor of the central bank for his Naira design policy at the bankers committee? Was this like a way of getting back at them? Because, you cannot take out the fact that we've all seen how the Naira design played out. Now, several months ago in October of 2022, we were discussing this topic on TV. And I remember I said specifically that I believe there was an ulterior motive for the Naira design policy other than the one the central bank had given. Well, time proved me right. Over the month, we saw it play out, and we've seen that there was an ulterior motive, And the intentions that they said was the reason why the policy had been designed is not what it played out to be.
All right,
so
but Kelvin,
I'm not.
Yeah, but you talked about targeting some of these bank chiefs. But what's the practice in other countries? Do we have tenure limits like these put in place in other countries for their banking industry?
The secular talked about to ensure corporate governance. It's quite amazing that he talked about ensuring corporate governance, because if you permit holding company structure, in my opinion, which is like a backdoor, and for example, if you look at BOFI Act of 2020 that was signed by the president in November of 2020, you look at sections 13(4) A, B, C of the BOFI Act of 2020 that talked about consolidated statements, consolidated account statements for Nigerian banks. And it basically said that if you're a bank or a subsidiary or a holdco, it defined the way for bringing consolidated statement. Now, what does that mean? That means that holdco and core banking operations are lumped together as one. And it presents systemic risk that the holding company structure is doing its annual returns or accounting with the core banking operations. Yeah? Look, if the holdco has risk-weighted assets that are high, and that reduces the capital adequacy ratio of the bank on the consolidated accounting model, it poses systemic risk to the core banking model. So I do not see the need for you to query the tenure limit of senior bank executives when you've allowed holding company structure that poses more systemic risk to the banking system than the tenure limit of the banks.
So is it that the 20 years is not enough? Is 20 years not enough?
The question you have to ask yourself is, what's the relevance of limiting the term of senior bank executives to 20 years? What's the argument for it? Is it necessary? Like, is it going to improve the performance of the banks? Is it going to improve their the quality of their regulatory capital? Is it going to improve the quality of their assets? Is it going to bring them more business? Is it going to improve the quality of their service? What's the case for limiting the tenure of senior bank executives, really? It doesn't make any material sense to me. I always say, Ladi, there are bigger fishes for the Central Bank of Nigeria to fry. And sometimes when they make decisions and release circulars, you begin to ask yourself, what really is the end game to this? And what's the relevance to the economy?
So looking at, this limit now, what would you say, are some of the pros to it, even though you've mentioned some cons?
Well, the pros, for example, might be, like they said, okay, you want to bring in fresh blood, you want to keep young bankers who are within the system from moving out of the country, so that they see a career trajectory and they can say, okay, the EDs and the DMD, they have a tenure limit, so at least there's an opportunity for us to rise through the ranks. But the question you have to ask yourself is, what's the percentage of staffs of banks, let's not even say contract staff, permanent staffs of banks that are actually recognized as direct staffs of banks and are entitled to benefits from the bank, actually rise to senior management? So, to be honest with you, I struggle to see the incentive and the, importance of, putting like a tenure limit on banks, because like I said earlier when we started, banking is a very delicate business. It requires a lot of experience, from treasury operations to investment banking to consumer banking. It requires a lot of experience. You have to deal with regulators, you have to deal with your board, you have to deal with shareholders, you have to deal with customers, you have to deal with operations. It's a lot of work. So to be honest with you, I don't see the case for it. I don't see how relevant it is to the economy at this material point in time.
All right, let's look at it from the angle of investors now. How do you think this will impact, investor confidence? Some investors might be attached to, a particular executive because of maybe performance or profit, delivery. How do you see this impacting investors?
Well, I think it's going to impact investors negatively because, like you said, performance. Investors, they invest first in the team and the leadership than they invest in the product or service. So it's important that they know that the people who are at the helm of affairs and that will take on the saddle and succeed are people who are well trained and grounded. I said earlier that you require somewhere around 15 or 18 years of actual experience to be able to qualify for the position of maybe a deputy managing director or a group managing director of a tier 1 bank in Nigeria. It's not a cakewalk. It's a lot of hard work and a lot of understanding and rigor, and grits, both the ones that you're taught and the ones that you observe and you learn. So it's not. I think it's going to have a negative connotation for investors, and I don't think it's a good omen. But overall, I honestly believe that the banking industry is one area that has weathered a lot of storms, and this is another storm that is going to weather. It's going to survive. They're going to, I'm sure they have fail-safes, and they have sustainability planning in terms of leadership within their conduits to train people who take over from them.
Yeah, it's definitely been a tough first quarter for banks with the whole cashless policy and how customers have reacted to the banks because of all of that, and I guess they still have a lot to deal with. But how do you see this impacting the whole banking industry in 2023? What are you seeing going forward?
Well, the banking industry has quite a number of headwinds. It's survived a very turbulent period of retail customer aggression because of the whole fiasco around Naira redesign. For me, one of the most important headwind I think the banks are going to face is the fact that Moody's, for example, downgraded Nigeria's rating to CA1. And because the sovereign rating has been downgraded, the banks automatically gets downgraded. 9 banks have also been downgraded, which means that their credit quality is affected. For me, that's one of the most important headwind that the banks have to face as the economy goes down and it sinks into debt spiral cycle and the credit quality decreases. It has an impact in the ability to be able to maintain foreign credit lines or go to the corporate Eurobonds market to raise capital. So on the other side, I see this as an opportunity for the debt capital markets, the FMDQ and NG Clearing to actually step up to the plate and mobilize capital for banks and for companies to be able to do business and increase the debts and trust of the debt capital markets in Nigeria. But the risk from the downgrade of Nigeria's sovereign rating is actually one major area I see impacting the performance of Nigerian banks in 2023 and 2024.
All right, I guess we'll keep watching and hope the banks are resilient enough to stand all these headwinds. But thank you so much, Kelvin Emmanuel, economic expert. It was great having your perspective today.
Thank you for having me.
Thank you. All right, we'll take a break now. When we come back, we'll head on to the commodities market. That's in a moment. Just stay with us.